Below old lows is sell side liquidity, basically sell stops. Above old highs is buy side liquidity, basically buy stops. That is liquidity, okay? When we have a range, like from this candle's high and that candle's low, now if you're not looking at old highs and old lows for liquidity, you're looking for inefficiencies. For instance, like this candle's high to that candle's low. Only one candle passed between this candle's low and this candle's high. This is a buy side imbalance, sell side inefficiency. It is not a liquidity void. A liquidity void is an actual gap, like this. Between this candle's high and that candle's low, that is a liquidity void. In between this candle's high and that candle's low, we only have this single candle passing through. Which direction did it pass through between this low and this high? Down. So to balance this out, it has to go through it once. It comes up into it halfway. That's consequent encouragement. And then comes back up one more time, a full return. See that? So we have a pass through down, then a pass up. This area here becomes a balanced price range once we leave it. So inside this 4-hour candle, we're going to leave this here and we're going to come back into it with a lower time frame. But just note that these levels here, in fact, let's change it to a heavy dashed line, and it'll make more sense when we get into lower time frames. This candle's high, that candle's low, that's your buy side imbalance, sell side inefficiency on the hourly chart. Now we can drop down into the 15. That's that same range there to there. But now we have more candles in it, okay? So I'm highlighting the fact that we have this range between this candle's high and that candle's low. That's this right here. Okay, I'm holding it so that we can see the difference in the contrasting blue colors. But we have a buy side imbalance, sell side inefficiency here on the 15-minute chart as well. And this yellow one, we'll see that when we drop down to the 5-minute. Okay, and here is the 5-minute chart. And we're going to scrub over here to same thing. This one candle here, it's high right there. That candle's high. That candle's low. That's what I'm highlighting, and that's what the yellow range is showing. Okay, so that's the 5-minute fair value gap. So what we have is nested PD arrays in the form of a fair value gap. The larger one here on the 4-hour, the hourly is with the trend lines, the 15-minute chart, and then finally the 5-minute chart. So reducing all of the things down to a 5-minute chart and these relative equal highs over here. We'll see that on a 1-minute chart. It'll align. If I move it here, it messes up the alignment I have for my 1-minute chart savings. So here we have it leaving that balanced price range earlier with that liquidity void, the real liquidity void. It leaves it, breaks a low there, and comes back up and just says, I can't get back up in there, and even leaves what? That little gap between that candle's low and that candle's high open right there. And then it moves lower down into the hourly imbalance, digs in deeper into the 15-minute chart imbalance, and then into the 5-minute chart imbalance right there. And then you watch me record a 5-handle move using the volume imbalance, which you'll see when we get into a 1-minute chart. You can watch the recording on Twitter too. It was shared yesterday or Friday morning. And then we have a market dive lower back into this old order flow here. Then it gets sloppy. And my attention was on the 3864, which is how I left Twitter Friday morning. I said note 3864, the relative equal highs. Okay. That was also shared in the chart in the morning before the markets already started moving around a lot. market trades down to the low end of that 4-hour imbalance, trades just a little bit outside of it, then hits the low. Look at that. That's perfect. That's precision. Market rallies, comes right back up into both the hourly, the 15-minute, and the 5-minute. And I'm extending all those ranges into time later in the day. So if we take our vertical line and annotate the 3 o'clock hour, which would be 1500. I apologize, I should have said this at the beginning, because if you're looking at TradingView, you always, no matter where you are globally, you always have the time settings on TradingView set to New York. If you don't do that, number one, you will not be in alignment with the algorithm, and you will not be in alignment with my analysis. You'll be hard pressed to find the things I'm showing you in the chart. It'll be confusing. I know it may be an adjustment for you, but trust me, the markets run on this time. Okay, forget anything else anybody's ever told you. This is what you use. Okay, so just scroll through on TradingView and make sure your time is always set to New York. Now for indices, if we're seeing daylight savings time effect, because every year they talk about how they're likely to do away with it. I wish they would personally, but whatever you're doing, if you're trading index futures, you're going to always use New York local time, whether it's daylight savings time or whatever. Okay, it's never an issue for me for trading Forex, but for stock indices, I'm going to be using it relative to New York time. Okay, so hopefully that clears it up for kill zones and operating hours. Now we're going to drop down to a 1-minute chart. Okay, and here is the PM session, 3 o'clock to 4 o'clock. This is a small little window of opportunity that if you are looking for just something that is going to be a real easy, small window of trading, you don't have a whole lot of time, and you want to just really go in there and look for something that's going to offer 5 handles or more. 5 handles would be like this. If you have a move, say from 36 even down to 31 even. Okay, that much of range is 5 handles. It's not much. And you can see having that, there's lots of opportunities to find 5 handles in all this movement. I know it probably doesn't feel like it's easy, but I promise it's there. It's very easy to do after you know what you're looking for. What is it you're looking for? Well, we had a buy-side liquidity pool at 38.64. Okay, that's what this level is here. At 3 o'clock, what I'm looking for is a reason to trust that it's going to run to a pool of liquidity, which I had already made known publicly in the morning session. So before lunchtime even began in New York time, noon, you all knew my attention was on 38.64. All right, so after 3 o'clock, what I'm looking for is a reason to anticipate a move up into that 38.64. Okay, so we're going to take this off because it's just more or less me glad handing with the viewers on the fact that we went up into this area. So we have this 5-minute fair value gap, which I'm going to bring to the forefront. Okay, so now we see this, and we also notice that in here, this movement here started somewhere. Where did it start? Well, we're already in the upper portion of this range from the 4-hour. So this range here, see that middle point? We're above it, which is what we want to see. Now, don't confuse that with, oh, you're going long in a premium. That's not a premium. That's not a premium at all, because we are now in the last hour with the expectation that we're going to run above that 38.64 because there's buy-side liquidity resting above that. I drew everyone's attention. That's where it's going to go. Why? Because the likelihood of us seeing a short covering rally. Now, here's where my viewership gets divided, because some of you may be may have been trading for a long time. Maybe you learned from other people. Maybe you've adopted your own opinion about what the market does, what it doesn't do, how it books price, which things make it move higher or lower, what causes it to stay stagnant and go in consolidation. The market will rally because the algorithm keeps offering a higher price. And anybody that comes in at market, guess what they're getting filled at? That price. And as long as the algorithm keeps spooling, which means it's going to keep moving and offering higher prices, initially, anyone short, they won't be swayed by that. But eventually, as it just keeps grinding higher, offering higher, and not allowing lower prices, it does not matter how many people are coming in going short. That doesn't matter. If the algorithm is going higher, it's going higher and it's going to squeeze you out. Now, when it doesn't suit the trader or educator's narrative for why their pattern didn't work, they will fall back on, well, it's because there was a short covering rally and the market squeezed traders out and short covering made price go up. No, the algorithm is pricing higher. And as a default, participants that are covering are forced to do what? Buy it back to get out of their short, because you have to sell to get in it first when you're trying to make money going lower. Well, anyone that's been short, as this is going higher, they're contemplating whether or not this is a good thing to hold on to. And with the last day of the year, and you want to be able to book your profit so that way you have earned your capital gains and now you can pay your taxes on it. This movement here is just going to keep driving higher and higher and higher, which is what I was expecting, what I outlined in the recording on Friday morning. And you're welcome to go through that video again with this insight so that way you understand what it is I'm explaining. This is not buying pressure that drives it up there. This pool of liquidity above 38.64 is the pressure. Okay, the market's going to go up there because that's where the orders are. What orders? Buy stops. Okay, anyone that's short, they have a large pool of orders collectively around and just above 38.64. So the algorithm sees that as an old reference point. It cannot, listen to me, it cannot see your order. It can't see my order, but it knows by its coding that that old relative equal high, which is two old highs, which is what I drew out on your charts in Twitter. Go back and look at it. You'll see it's there, and you'll actually see there also, even in the morning trade where I'm trading. I make sure that that is it's in the filming of the screen. I want to make sure that that's in there because that was the real move of the day, getting up to here. This is during the lead up to the last hour of trading. Then we have the movement here. You don't have to be a buyer here. You want to look for that real easy setup, the real easy setup where everything's lined up perfectly. The market rallies, creates a small little imbalance right here. Now I'm going to take the 15-minute off to start cleaning up this little area in here, but I want you to kind of like recall where these things are. And if you're doing it in your own chart, you'll see it too. 1 minute, buy side imbalance, sell side inefficiency, fair value gap. Okay, look at this candle's. Now you're going to look right here at this number right there. Okay, this candle's high. What is that? It's 38.39 and a quarter. Okay, 39.25. Just remember that. What's the low of this candle right there? 38.39.25. Perfect. Did it go one tick below it? No. Did it fall short of getting to the bottom of it? No, it went right to it. What about this candle right there? What was the low of that candle? We're looking at this number right there, okay? That low is 38.39 and a quarter. What about this low right there? Right here on that candle. 38.39.25. Folks, that's perfect. Okay? That is absolutely perfect. You cannot argue. You cannot improve upon. You can't say anything could have done it better. I outlined it real time. It was recorded. It was executed on. And you've seen the delivery. Okay? If there was not an algorithm, price wouldn't do that. My stop loss was placed just below here, right at that candle's opening. Why? Because it's going to respect that 1 minute fair value gap because we've already did what? This is the hourly. This is the low of the fair value gap on the hour. This is the high of the fair value gap on the hour chart. So I watched as it went down. We went through it to touch the top here. We hit it. I bought it first at the top of the fair value gap using that right there. I wanted to go in with that, and then I added more, and then I added it one more time just to show you that I was not fearful of the stop being hit, because the logic is that 60-minute fair value gap is now going to support it because we've already closed in the 1 minute. There's no need for it. There's no need for it. Why? We're also running out of time. It's 24 minutes. 24 minutes after, 25 minutes after 3 or 15:25. So now the market's going to have to start doing what? Gravitate towards that liquidity up here. Short sellers are going to want to cover, and they're going to be enticed to cover because of the algorithm repricing higher, 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 higher. When do I know it's really going to kick off? Once this shows all the bodies being unwilling to close at the low end of that 60-minute fair value gap. Once I see this, I'm waiting for the market to want to leave this area, and it starts to move here. And then right there, this candle, that's exactly what I'm looking for. The market's starting to break away, take off. A lot of acceleration. Once it does this, it creates another, what this is here, a fair value gap. But this fair value gap is likely to stay open. What does that mean? Much like this gap here, I mean, just for the second here, I'm going to darken it up a little bit. Okay, between this candle's high and this candle's low right there, that's what I'm shading in as a rectangle. The market comes completely down and fills that in right there. And it does it again here, and it does it again right there. Perfectly. Perfectly. That's not support and resistance. That's not Wyckoff. That's not supply and demand. It is absolutely the algorithm. Okay? And once it does this, it completely closes that in and then leaves it. But it starts off another fair value gap right as it leaves this one. So it's not going to do what? It's not going to be consolidation, expansion, reversal. It's going to be consolidation, expansion, and continue. It can consolidate and then run higher, but it's not going to consolidate, expansion, come right back into a retracement. That's not what it's going to do. The algorithm's going to leave this little area open. And you watch me do 2 examples of it this week. I identified it before it even proved to you as the viewer it wasn't going to go back in and close this range in or overlap what you see here. This up candle, that range between this candle's open here and this candle's low here, that one single up candle, that green one. Let me take this off for a second. This one candle gets overlapped right there. So it's going up. It has to do what to rebalance it? It has to go down. So now we've done what? We've offered buy side delivery, sell side delivery. And then when we leave that range here, once we get back above this candle's low, this is a balanced price range. It's not going back down there, especially if we have one single candle pass through again where it's taking off. And then we have this candle. As soon as this candle closes and we start this candle right there, then I know that that gap is there and it's going to stay open. But what happens if it starts to go back down into this low right in here? I'm going to buy it and knowing it's not going to go down here. And my stop would go just below the bodies of these candles here, which is where it went to next once I trailed it up. And I'm going to watch these candles paint and watch and see how they gravitate towards this pool of liquidity, which was 38.53 and a half. Once this was filled, again, it's all short-term high. Back here, buy side right there. It gravitates to that one. So this one's no longer salient. We don't need to worry about the hourly because we've already left that range. it's gone. And all of the trades and the executions, which I gotta add now that little rectangle back on here because otherwise it won't show as nicely as I want it to. And we'll just do it with, that's good. Okay, and here's the 5-minute fair value gap. This breakaway gap, which is what this is, it's a fair value gap, but it's a breakaway gap. A breakaway gap in this is not likely to be traded back into. You don't want to see it traded back into. And if we take this 5-minute off, because now we know that that's where it's likely to occur, this suddenly takes on a whole new dynamic when you see everything I'm doing. I'm buying at the top of the fair value gap right here as it goes into here. And then I'm buying it here and here as it's tagging on a 1-minute candle, trying to time it as it hits it, boom, boom. And then right in here, I'm adding one more because this is a breaker.